So, Mish, the St. Louis Fed puts out an indicator, a financial stress index, and right now it's pretty close to its all-time lows. What do you think? Is that reflective of the type of economy we're in today?
It's reflective of the artificial economy we're in, absolutely. The only other time the stress indicators have been this low was in 2007, right before the housing bubble blew up. The stock market plunged, Lehman collapsed. So the construction of this index is a bunch of artificial things. The Fed puts this thing together by looking at the prices of financial stocks. It puts them together by looking at junk bonds. It puts them together by saying, hey, you know, the yield curve is not inverted yet here, so that's a good thing. And of course, the yield curve cannot invert with interest rates here at zero.
Oh, it sounds like somebody's studying to a test they wrote. Tell us a little bit about the real economy then. If this artificial economy says it's so healthy right now, what do you see on the horizon that's struggling in the real economy?
Well, people don't have jobs. There's still the unemployment rate has fallen dramatically, but most of that has been people dropping out of the workforce. You see the same thing going on in Europe. We have Abenomics in Japan. We have money supply growth growing at a 13–15% annually in China. And so all of these things that are supportive of the financial markets make things look pretty, when actually the underlying details for what the central banks have to do just to keep GDP barely growing at 1 to 2% in the United States, and a huge slowdown coming up in China, and we're back in recession levels in Europe, and the central banks globally are trying to get people to borrow, banks to lend. It's not happening because there's too much debt in the system already.
Yeah, but hasn't the economy proven itself healthy? I mean, the stock market is up, company profits are up, we're sitting on record amounts of cash on company balance sheets. Aren't those all good signs for the economy?
Well, let's talk about cash first. The record amounts of cash on the corporate sheets on corporate balance sheets is actually a reflection of debt. There's only a handful of companies that actually have any real cash if you actually go and look at it. Apple's one of them, Microsoft is one, Google, yeah, they have cash. They're extremely profitable. Most of the rest of the cash you see on the balance sheets of corporations is actually debt. If you go subtract, and I've posted these charts on my blog, if you subtract debt from the cash, you will see that corporations have all-time record debt that dwarfs any cash that they supposedly have on their balance sheets.
What are the implications of this debt? I mean, what comes to pass? I mean, we're in a low interest rate environment. It can't cost all that much to service it. What's the risk there?
Well, it's artificial. Corporations are borrowing money because they can. To a certain extent, it's probably a smart thing to do. What happened in 2009 is corporations couldn't get credit. So you had some viable corporations about ready to go out of business that were going to go out because they could not get the next round of financing. Corporations sort of learned a lesson, but unfortunately they forgot it. A lot of the cash that they've borrowed is now going into buying back their own shares, artificially raising the price of stocks. They've forgotten their lesson already. And so we're seeing leverage not only in corporations, we're seeing leverage from investors as well, who are saying, you know, okay, bond yields, global bond yields are 1% for 45% of the global bonds. So for investors, hedge funds, pension funds who need an 8% return, the only way you can get that in a 1% world is to use leverage. So leverage is going up everywhere across the board, you know, from investors, from corporations, stock buybacks. In the ECB, in Europe, banks are extremely leveraged to their sovereign bonds of their own countries as if there's no risk at all, when in fact there's phenomenal risk everywhere if things look pretty just because the bubble hasn't popped yet.
Is there some kind of flashpoint that could trigger some of this risk to unroll, some of this leverage to unwind?
People are always looking for a flashpoint, and a lot of times what happens is pure exhaustion. If you look at the housing bubble in 2007, there was, when it bust, there was no real catalyst. People were standing outside in Florida entering lotteries for the right to buy a condo, and the next day, or a week later, the lines vanished, no one's there. There was no trigger, there was no catalyst. Instead, what changed? Sentiment. So sentiment can change at any time, yet there still could be a catalyst. The Russia-Ukraine crisis can blow up. We've got warmongers in the United States just itching for a war with Russia. You've got 53% of the people in China believe that there is a war coming with Japan. Europe is a powder keg here because of rising unemployment and debt. And Mario Draghi is trying everything he can to spur lending there, but credit corporations don't want to borrow and the banks don't want to lend. Why? Because they're capital impaired, but we don't see it because the ECB doesn't admit it. So they only tell people what they want to hear. So there doesn't necessarily have to be a catalyst here, yet there's a catalyst everywhere you look. Abenomics is blowing up. Japan has negative 7% growth in the last quarter, and we're looking at that. And so what's Japan going to do? It's going to double down. It's already got debt to the tune of 250% of GDP, and here we are, trying to spur more stimulus in Japan to get the Japanese economy going. So I think the yen is poised as the next currency that's going to plunge. That can be a catalyst for the market. There's all kinds of them. But what we find happens a lot of times is this a catalyst out of the blue, something that's totally unexpected. And maybe Marine Le Pen wins in France and takes France out of the euro. All kinds of things can happen. We're just waiting for either exhaustion or the catalyst.
So whatever that tipping point is that turns the market the other way, with all of this competitive devaluation that you mentioned between Japan and Europe and America all sort of racing each other to the currency bottom so that their economy will be the export leader, what's it likely to look like? I mean, is this going to be just a stock market crash and 2-3 years later we're back up to where we were like the last time around? What do you think the implications are whenever this exhaustion does set in?
I think we have two things that are happening. I think there's going to be a sovereign debt crisis in Europe just because of the leverage. If you look at the yields in Europe, the 10-year yield of Italy, the 10-year yield in Spain are lower than the U.S. Treasury yield. These things are priced as if it's impossible for there to be another debt crisis in Europe. Well, we've already seen two, and neither one was supposed to happen. If you remember, Jean-Claude Trichet, who was the president of the ECB, came out and said, we say no to default. We say no to selective default. We say no to this, as if a pronouncement, we say no is going to carry the day. Well, it didn't. And then we heard that, well, this is just a one-time. This can only happen in Greece. It's not going to happen anywhere else. What happened? Cyprus came along, and Cyprus was out of the blue. And all of a sudden, Europe had a second financial crisis. Mario Draghi responded to that with LTRO, drove interest rates all the way, into the gutter, lower than the United States, and they're priced as if there is no risk on these things. And they don't count as leverage, but the average European bank is leveraged far more than the average U.S. bank right now. So, all these people are just waiting for the United States to crack. I think something else is going to crack and drag the global economy down with it.
Interesting. So if euro is the straw that broke the camel's back, if it's the first one to go, what does that really mean to a North American investor, the average person in Canadian or U.S. equities? What do they have to do to prepare for something like this?
Well, what the average investor should be doing is actually looking globally for opportunities outside the United States. The 10-year PE in the U.S., it's somewhat of a safe haven now, so everyone's flocking to U.S. stocks, and corporate bonds and junk bonds are at all-time record low yields. So, and this is one of the things that central banks, not just the Fed, have done. That they've fostered this environment that can't lose. So you need to think, outside of this, and then think about the implications of not just outside the United States, but what a slowdown in China might mean. And we've already seen it. We've seen copper prices tumble. We've seen iron prices absolutely plunge. So, everyone has this idea that China is going to keep growing 7% a year, when actually I think China is going to grow 1 or 2% for the rest of the decade. So what are the implications of that? What are the implications on natural resources? What are the implications on treasuries? I happen to like Japan as an investment place, but only if one hedges it against the yen, which might absolutely crash. So you need to look at opportunities, and right now gold is performing very poorly. And and one of the reasons is this belief in the Fed, in central banks, that there's no stress in the system. And that's what the Fed says. That's what their chart shows. That's how the stock markets are reacting right now. Well, gold does well in times of stress, and it does pretty poorly in times where there's not stress. So I'm looking ahead and I'm saying, what happens not if, but when stress picks back up. So I'm looking at gold. I like cash. There's various currencies. One might want to actually even hide out in U.S. Treasuries as a play. Nothing else. The money's going to go somewhere, and so just look at global opportunities instead of throwing money in equities and using leverage.
Interesting. You mentioned U.S. Treasuries almost as a place to hide out, but if interest rates are to rise, if the economy does start doing well, aren't Treasuries sort of a trap waiting to happen for investors? Aren't we going to see these incredibly high effective durations of the Treasuries really slaughter the values of the bonds?
What's your time horizon here? If we are going to see this global currency crisis, which is actually what I'm predicting, we're going to see a flight to the safe haven and a bid for things like U.S. Treasuries, especially if the sovereign crisis that I expect to happen hits Europe first and perhaps Japan second. There's going to be an automatic bid on treasuries. I'm not saying own these things for 30 years or even 10. I'm saying rent them, now as a safe haven for this crash that's coming. So that's just one idea, and certainly just sitting in cash, waiting for a better opportunity. The U.S. dollar will act as a safe haven, providing the crisis starts outside of the U.S., as I suspect it will. So the thing to do now is just to a lot of extent, is just wait for better opportunities that I think are going to come down the road. Less leverage right now, maybe hide out in some treasuries, have a lot of cash, be ready to act when the crisis does hit, and have some gold as a safe haven while you're waiting for this global currency crisis deleveraging to play out.
It sounds like we should be sitting on the side of the road when these Mack trucks hit themselves head to head. Well, thank you very much, Mish, for being here. If people want to read more of your opinions, learn a little bit more about the research that backs these investment conclusions, where can they find information about you?
They can do a Google search for Mish, M-I-S-H. It's the first two characters of my first and last name, and it'll take you straight to my blog. I've got the second or third most popular economic blog in the country.
Great. Thank you for being here.
Thanks.